Okay, good afternoon and welcome back everyone to our our Thursday afternoon live market analysis session, which is a continuation of our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today what we're going to do is really spend the time to review what we've learned during the month of August. This is a time to recap and remind ourselves as far as what we learned, and more importantly, show you how to apply it to the current market. Because we always want to make sure that not only do we teach theory, but more important, implementation, so that we can show you how to actually leverage these strategies for your own portfolio. So those are the things we're going to go over here today. But before I do, what we're going to discuss here today is for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we're going to start off with a brief market update. This is giving you a glimpse into what I typically spend half an hour on Tuesday and Friday morning during our market outlook session. So please join us tomorrow morning for a more formal and up-to-date format on this. But the topics that we covered here this week were the benefits of options trading. This is for those of you that are beginner options traders, to learn more about the fact that when you trade options, or when you learn how to trade options, that road many times can be a bit daunting. There can be a lot of terminology and complexity that you find confusing. So what we wanted to do was skip a little bit ahead and show you that once you go through the learning process, what do you actually get at the result of that? How can options benefit your portfolio? So those are the things that we explored, and we got into the concepts of a call and put option. And we talked about the difference between buying and selling call and put options to really drive home the fundamental building blocks, because next month we're going to start talking about strategies that you can deploy in your portfolio. So we want to make sure that you understand the fundamental building blocks before we move on to the actual strategies, because this all builds on top of each other. This is the educational experience that we're trying to provide all members, so that you have a better understanding as to how to, go from crawling to walking and eventually running. And for those of you that were able to join us here on Tuesday, we had a pretty spectacular event here with Tom Sosnoff from Tastyworks, where we went over an option strategy guide. So we're going to do a quick recap of that, and then what we're going to do is some trading analysis together. So this is where you have an opportunity to submit some symbols that you want to take a look at, and we will look at the markets together in the context of buying and selling options, talking about basic calls and puts, and at the very end, we'll answer your questions here. So with that, before I get started, I just want to get a quick poll here of the audience. How many of you are brand new to options trading and you're still in the process of learning how to trade options? Please type 1 into the chat window, which is at the bottom of your screen, if you are brand new to options trading and you're still learning. If you have some experience trading options, or if you're currently trading options, please type 2 into the chat window. Okay, so I certainly see a lot more 2s than 1s, but I still find that there's probably at least a third of you that are new to options trading and learning how to trade. So perfect, let's go ahead and get started. But I think the primary question that I think is on many investors' minds right now is, what is the catalyst that's actually going to drive this market lower, right? Because I think that at this point, you would be pretty crazy to not think that the markets are overvalued, that there's potentially a correction coming. So if you're wondering if that's the case, don't worry, you're not the only one. And this is the thing that I've been trying to illuminate over the past, I would say, probably 2 months now, where consistently I can show you that markets are exhausted. There are signs that there are cracks in the market, but that is not a good reason to short the markets. And I've been pretty consistent on that view here. And my view on that still has not changed, despite the fact that we have reached new all-time highs. There are new signs of exhaustion. There are even further signs that valuations are stretched. This cannot continue to go on. But there's no doubt about the fact that markets are extremely strong, and you don't want to fight that. And now, what is the catalyst that's actually going to trigger that next sell-off? I don't know. I don't think anyone knows. The same way that we couldn't have possibly predicted coronavirus was going to happen, I don't think there's any way to predict what's actually going to trigger the next sell-off. So what's important is that you understand that there are warning signs, and there are plenty of them now. And I actually will show you here today how the warning signs have actually gotten louder here over the last week. But that in itself, the warning signs themselves do not mean to go out there and buy puts or short the markets. That is going to be a hazard to your portfolio. This is something that we have consistently seen year after year. If you could have said that markets were stretched, that they were about to near a top, probably every single month since December 2018. And you would have only been right about 3 of those months. So out of all of those times, you would have been wrong probably 85% of the time. And that's the key here to trading. And those are some of the things we're going to go over with you here today. So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay. I'm going to start off by sharing with you my charts, my research, and what type of warning signs I'm currently watching in the markets, and showing you how I'm positioning here in the market using options. So just a quick recap of the things that we went over during our benefits of options webinar. We talked about the basics of calls and puts, and we talked about there are 4 fundamental strategies. You can buy a call, buy a put, you can sell a call, and you can sell a put. So we discussed these 4 strategies. We went over some examples of buying a call, buying a put, and showing you when it makes sense to buy a call, when it makes sense to buy a put, and showed you those examples. So for those of you that maybe missed that webinar and you want to learn these basics, I highly recommend that you follow us on YouTube, and I will post a link here when we finish into the recording for this webinar. It is absolutely important if you're brand new to options trading, and for those of you that answered 1 on the initial question, that you go and review the webinar recordings before you move on, because you need to have the fundamental building blocks before you start trading, before you start looking at the more advanced sessions. Then we talked about the difference between buying a call and selling a put. These are the 2 bullish strategies. This was in our second webinar where we talked about the difference between buying versus selling options. And we discussed the distinct difference, because both buying a call and selling a put technically are bullish strategies. But when you actually dive into it, you'll see that buying a call is not just bullish, it's bullish by a certain amount. And that's predominantly influenced by how much you pay for that call option. Vice versa, when you sell a put, it's not technically bullish. It's somewhat bullish, but not by too much. Meaning if you are very bullish, you're much better off buying a call option rather than selling the put option. And for the bearish strategies, you can either buy a put or sell a call. And for both of these strategies, same thing. Even though technically they're bearish, they're not, in my opinion, accurate descriptions. Of buying a put option is bearish by a certain amount, and that certain amount is determined by how much you have to pay for that put option. And vice versa, when you sell a call option, even though that's technically a bearish strategy, it's really not. It's more of a neutral strategy, because you don't want to be too bearish. Otherwise, you're far better off buying that put option. So that's what we explored in our strategy session on buying versus selling options. And for those of you that are in the process of learning, if you've traded single leg options and you're thinking about learning about trading multi-leg options like vertical spreads, calendar spreads, and you want to trade strangles, diagonals, butterflies, condors, you must make sure that you start off by learning the fundamental building blocks. And these are the 4 fundamental building blocks of options trading. So again, if you're brand new to options trading, make sure you learn this before you move on. And then on Tuesday, we just hosted what I thought was a fantastic event with Tom Sosnoff, and I'm really excited to actually have him back here on September 15th. So he'll be back here in just less than 3 weeks. And we're going to do another session where we're going to give you a much better understanding of the Tastyworks platform. You know, I personally trade with Thinkorswim, but I've been playing around with the Tastyworks platform. And for those of you that trade options, there are some significant benefits to that platform from the perspective of the things that Tom and I spoke about. And we had a very in-depth discussion on Tuesday of the best practices for each individual strategy. We covered everything from cover calls to cash secured puts, long calls and puts. We covered debit vertical spreads. We covered credit vertical spreads. We covered calendar spreads. We covered iron butterflies. We covered iron condors, straddles and strangles. Those are all the strategies that we covered, and we took the notes down for you and we sent them all out to our members. So please, if you have a membership, you can sign up and get access to all of these notes that we went over here with Tom. So with that, what I want to do is I want to jump over to I want to first take a look at the broader markets here. And again, this is giving you a glimpse into what we typically do every single Tuesday and Friday morning session, where I go over my charts. I show you what my views are using the charts, the broader markets. We look at the broader indices. We look at indicators that I think are important. We look at economic research. We do all of that, and we show you what my views are and how I'm positioning for the markets utilizing options. So those are always recorded as well, so you can get those on YouTube. So follow us on YouTube, youtube.com/optionsplay. Please make sure you subscribe and click on the notification bell this way that when every time we upload a new session, you get an email notifying you immediately. So let's start off by taking a look at the broader markets. And I usually start off with the S&P 500, where one of the major things that we've brought out is that now that the S&P 500 has recently broke out above all-time highs, which just happened this week. I was out last week, but the market stayed pretty quiet last week. And when I got back here on Monday, we finally broke out above that 52-week high from February 2020. And what we have here is the fact that as markets continue to move higher on the weekly chart, we're starting to see negative divergence here on the weekly chart. And this is something that in itself is a warning signal, but is not a reason to go short. And this is something that we explored here in the NASDAQ 100 index. I've been showing this for weeks on end now. We've been talking about the negative divergence that has happened here in the NASDAQ 100 index. And the NASDAQ 100 index is a good example of how negative divergence can go on for weeks, if not months, and they can go on for a long time. So that in itself, just because you see that negative divergence does not mean market's about to turn lower. We saw negative divergence on the daily and weekly charts, where we were seeing that as the stocks were making higher highs, the market was, the momentum was not confirming that. These were the same type of warning indicators that we saw before the February COVID-19 sell-off. So these warning signs are telling us things are not all okay. But like I said, it's important that we look at these indicators in the sense that they are just warning indicators. They are not signals to actually go short. However, what has deteriorated quite a bit here over the past couple of days is a significant deterioration in the health of the market. So we've been talking about the health of this market for those of you that have been joining us every Tuesday and Friday morning. We've been talking about it in the sense for, is the broader market participating on this move? And we've been looking predominantly at IWM, which is small caps, and for the most part, from the May to June rally, small caps held up, it kept up with the broader market. It lagged for a bit of time and then played a bit of catch up. But over the last few weeks, as markets, NASDAQ 100, the S&P, and even the Dow continue to climb to new all-time highs, the small caps did not keep up. So this is the first sign that the health of the market is starting to deteriorate. We see this across equal weight indices as well, because the S&P 500 is a market cap weighted indice. So when we look at the equal weight indices and we see that the equal weight is not catching up, that also is concerning to us. This is another warning sign that things are not all okay. And again, for those of you that are wondering, how can this market continue to go on higher? You're not the only one wondering this. The same thing. Everyone is thinking the same thing. But again, just because you see this does not mean it's necessarily a good idea to go short the markets. You're much better off in these type of market environments to use strategies like cover calls, generate income on your portfolio, because if and when the market does accelerate to the downside, due to the warning signs and the stretch valuations we're currently seeing, we do expect that next sell-off to be fairly fast and violent. When that happens, put options will be expensive. So you want to make sure that you generate premium now to use that premium to buy put options if and when it is necessary. I would say it's not a matter of if, it's simply a matter of when. Now, One of the things that I did want to point out here is that the deterioration of this market has gotten significantly worse this week, because as both the S&P and the NASDAQ 100 index made new all-time highs, the VIX, which tracks the implied volatility, the S&P 500, no longer made a new low. It actually spiked higher here today. It's up about 5%. This is telling us that investors are fearful. Investors are going out there and potentially buying put options on the market. This is one warning sign that we currently have. We see this both on the SPX as well as the VXN, which is the NASDAQ 100 VIX. The NASDAQ 100 VIX is actually notched 2 consecutive days of higher highs while the market makes higher highs. This type of warning signal is pretty massive. We usually don't see markets make all-time highs while volatility index also makes higher highs. And one other statistic I wanted to point out, and I think people will be surprised. I'm curious as to, if you had to guess, what percentage of S&P 500 stocks are trading above its 20-day moving average? Now, you think about it, markets are at all-time highs. You would expect that most stocks in the S&P 500 are trading above its 20-day moving average. I'm curious, how you can type into the chat window, what percentage of stocks do you think are trading above its 20-day moving average? Normally, with this type of market at these all-time highs, you would want to see somewhere in the 70s, 80% market, 80% of those stocks trading above its 20-day moving average. I see a lot of numbers, and they're kind of all over the board. Some people saying 10, 20, 30, 40, 50. It's all over the board. The answer is 51%. Only 51% of all S&P 500 stocks are trading above its 20-day moving average. How many of them are trading above its 50-day moving average? Only 64%. How many of them are trading above its 200-day moving average? Only 51%. Only 50% of the stocks in the universe are trading above its 200-day moving average, meaning half the stocks are trading below its 200-day moving average. That is the signs of a very, very unhealthy market. If you look at advanced decline lines, they are no longer confirming these moves higher. So again, things have significantly deteriorated here over the last week as we've had this massive push here to the upside, day after day after day of new highs. So this again is a warning sign that is getting louder. But again, the warning signs in itself does not mean go out there and short the markets, because markets can resolve this stuff with a relatively small pullback here. It is possible that it pulls back to the 339, 335 level and then continues to resume higher. That has been our base case for the last few months. We've been talking about this, and I sometimes get angry emails from members saying, how the hell can you continue to, advocate for long positions here in this market when we clearly know that the economic and fundamental backdrops do not support this? And I will say, you can't fight the trend. Don't fight the trend. It's going to be a losing battle if you try to fight the market. So just be aware of these things. That's the most important thing. And we keep you updated on these types of things on our Tuesday and Friday morning Outlook sessions. So please join us tomorrow morning at 9 a.m. for those of you that want a more complete picture of what I'm trying to paint, because I also explore things like economic indicators, looking at the fundamentals of individual sectors and companies, and we look at sector rotation. Those are all the different I would say evidence that we currently look at to give us a sense for our macro views here in the market. But I would say the big news that has generated here over the last couple of weeks is really the fact that yields have started to pick up, especially after today's announcement from the Fed, where they've effectively committed to long-term low interest rates, and we've seen a significant uptick in terms of yields across the curve, and the curve has steepened. This is one of the, again, another warning sign from the market saying not everything is okay. So there's a lot of things that are here at play. This is part of what's pushed gold and silver down here today, because rates have started to pick up here. So there's a lot of factors at play. Some of the things that we like out of this, comes from sector rotation. Those are things we're going to explore tomorrow morning. So I hope that you're able to join us here tomorrow morning for that. So with that, what I'm going to do is I'm going to, at this point, open this up for you guys to submit some symbols for us to do some analysis together. Please, you can type a symbol into the chat window, but please type in whether you're bullish or bearish on that stock, and I'm happy to take a look at it. And what I want to do is I want to show you, some stocks and how I would think about playing these stocks utilizing options in the context of what I just said, which is that fact that we are concerned about the market rally. We're concerned about where we're currently trading, and we know that if we do get some kind of catalyst, whether that catalyst is a US geopolitical event, whether it's the Fed, Fed policy, whether it's fiscal, whether it's monetary, whether it's something else like a revisit of, a spike in cases of COVID-19, these are all potential catalysts. We don't know which one's going to cause it, but if we do get some type of catalyst, we are likely going to see what is going to be a very outsized volatility event. So you want to make sure that when you seek opportunities here in this market, you do so in a way with limited risk. And that's really where options is a fantastic tool in helping you do that. So let's go ahead and take a look at it. Thank you so much for all the names. I don't think I'm going to be able to get to all of these names here, but I will take a look. And Bill had the first one, SPY. That's the symbol that I had up here. And I want to explore, let's just say that you think that this can continue to get stretched for quite some time. And I don't think that that is crazy at all. Despite all the warning signs I showed you, we have seen similar warning signs for the past few weeks. That has not stopped the markets from marching from relative highs to new all-time highs, day after day after day. And especially, we still have the coronavirus vaccine and treatment stuff that can potentially provide a tailwind here for the markets to continue get stretched. I was reading a lot of research here on the vaccines. We have multiple major pharmaceutical companies pursuing this. There's no reason that there isn't, some good news here over the next couple of days could potentially push this markets higher. That's what caused the markets to break out here on Monday, was optimism on some treatments. So that is still something that hasn't, granted it's priced into the markets to some degree, but I still think that there's plenty of tailwinds that can potentially push this market higher. So Bill wants to look at a bullish view here on SPY. SPY is trading at 348. So first of all, when I'm looking at strategies in this type of market environment, my primary focus is not necessarily upside. My primary focus is limiting downside. I want to make sure that if we do get some kind of sell-off, I have the least amount of capital at risk. So I will never do something like buying a stock in this particular market environment, because the next pullback is going to be very quick and violent. And I don't want to be caught in that stock position where I can't get out, or maybe my stop loss gets blown through and I take on significantly more risk than I intended to. I much prefer looking at strategies like a call option that gives me the same upside, but with limited risk. So no matter what happens, I'm risking the equivalent of $882 for every 100 shares, which normally would cost me $3,400. So $882 out of 34,840 is only 2.5% of the underlying stock price or the ETS value. So even if the market dumps 10%, I'm only risking 2.5. That is my primary goal. For those of you, since so many of you answered that you have some experience trading options, then I would take a look at the strategy here on the right. But the goal here is always to first look at how much money do I have at risk. So I would say in my 15 years of working as a market strategist, what leads me time and time again that I can see that sets successful traders apart from everyone else is not their strategy, it's not what indicators they use, it's how they manage their risk. And professional traders always look at risk first. That's the thing that they are obsessive about, is how much risk are they taking and managing that. And then what they do is they have rules-based approach to figuring out when they cut their losses, and they don't spend too much time worrying about losses, because guess what? As a trader, losses are part of your account. There's no way to avoid losses. So get over the fact that, that you're going to have some losses. Have a rules-based approach, be comfortable with it. So I always ask myself, if this trade goes completely south, am I comfortable losing $882 on this trade? Or am I okay with risking $765 if SPY takes a big dump on some kind of catalyst event that I can't possibly predict or know when it will materialize? If the answer to that question is no, meaning if let's say you have $1,000 account and you don't, or a really small account like a $2,000 account, and you say, I'm not comfortable taking on $882 worth of risk on a single trade, then you should not be placing this trade at all. You should always look at how much risk is there before you get into a trade. If you are comfortable, let's say you have a $50,000 account and you're saying to yourself, well, if I lose $882 on a single trade, I'm okay with that. I still have most of my portfolio intact to place my next trade. Then we can start taking a look at upside. So here's the tricky part. When the SPY is trading at new all-time highs, how much higher can it go? That's really difficult to tell. And this is part of where you can use some technical analysis to give you a sense here where you've had a fairly sizable move, you've had a consolidation, another sizable move, and now it's gotten even more extended to that. So even me as a technical analyst would say this is pretty stretched, and what we're more likely to see is some consolidation before it can continue moving higher. But I can use these previous moves to measure roughly how big of a move that I can get if I get a pullback here in the 340 level. And maybe I'll say that I'll get up to maybe 360 on a very extended move here. As you can see here, if I bought this call option, I'm looking at a 36% return. If I'm looking at a call spread, I'm looking at a 56% return. 56 certainly looks looks okay, but even that for me isn't particularly attractive. It's not the type of trade that really gets me excited, looking at a 56% return, because I am risking at the end of the day 765 to only make potentially 435. And that's, in my opinion, a good scenario. So perhaps you're better off if you're looking at a bullish strategy of selling a put spread. That might make a little bit more sense. So if you sold a put spread like a 348, 338 put spread here, you'll collect $3 here. So this is only 30% of the width. So that also doesn't look particularly attractive. So from my perspective, despite the fact that I don't disagree with you on your views on SPY, I don't particularly find any option strategy really attractive here. A 56% return, if I'm right, and I really knock it out of the park, does not really get me excited when I'm risking 765. And when I'm only collecting 30% of the width, here I'm making potentially $300, but I'm risking almost $700 on the back of that. So that's also not the risk to reward ratio that gets me excited. So unfortunately, here's an example where I have a thesis that I particularly like. Bill, I don't disagree with you that I think SPY can continue moving higher, but here's just an example where trades don't really make a lot of sense. So unfortunately, here's a trade where if you're bullish on the market, I think you're better off looking at specific symbols. So I hope that this gives you a better sense for how I, as a trader, number one, look at the markets, and number two, or more importantly, look at how can I manage my risk in the trades that I make in the markets. So let's look at this. Leonard has USO and he's bearish on it. This is one that I actually quite agree with in terms of oil. We saw a pretty big move here down to the downside here in most of the energy names, Exxon, Chevron, all of these are down. So maybe you think oil is going to continue moving lower. So this is where, USO is currently trading at $30. If you look at a 31, if you're looking at a put option here, it's fairly cheap here. It's only $155 on a $30 stock. So you're looking at about 5% of the underlying stock, underlying ETF value. So even if you're wrong on your thesis and the stock takes and the ETF takes off, maybe the hurricane causes some inventory issues and in the short term oil prices spike. Even if that happens, I'm only risking 5% of ETF, and oil is pretty volatile. So risking 5% is actually not a whole lot. But I can use a put spread here to really risk even further. I'm only risking here about 3% of the underlying ETF's value. That would be my preference if I'm looking at this type of trade. And on a $30 stock, I think most people can handle a $119 loss in their portfolio. But again, if you have a really, really small portfolio, maybe you only have a $1,000 portfolio, maybe that is too much risk for you. But always ask yourself, am I comfortable risking this amount? If I'm not, I have to move on to the next trade. Harris is asking CHGG's Chegg. If I'm not mistaken, this is the electronics retailer. You know, if I don't know much about the financials of this, but if you look at Best Buy, reported earnings relatively strong, but they actually, you know, have some supply issues here. I know, and I would imagine a smaller name like Chegg would probably have the same issue. So while I don't disagree with the thesis that online electronics is definitely by far one of the fastest segments of the markets in terms of consumer spending. Here, I'm risking $455 on a $75 stock. That's about 6%, 7% or so. But again, I would be weary if this stock, it's reported earnings already. So, but if it does pull back into the $63 range, here I'm losing $455. Ask yourself, am I comfortable with that kind of loss? If you are, then look at a vertical spread like this. SLV, bullish. So I will say that I'm not as bullish here on gold and silver anymore after the move here by the Fed, and rather the market's reaction to the Fed and interest rates rising, because interest rates rising higher is generally bad for non-dividend paying assets like silver. So if you want to take a bullish view here on silver, I think that the only way to do it is utilizing a call spread. Risk the smallest amount possible. A call spread here at $1.32 on a $25 stock is only about 5%. On SLV, which moves a whole lot or can move a whole lot, you know, risking 5% is, in my opinion, a reasonable amount to risk on SLV going out to October. SLF, bullish. This is one I also agree with because of the rise in interest rates. Not only the rise in interest rates, but the steepening of the curve. That is generally good for banks. I happen to like Morgan Stanley out of the major banks, but pretty much, you know, any bank that relies on loaning capital out is generally going to be benefiting from the steepening yield curve. So I agree. I think that for XLF, you know, if you want, I would go out to October. I would look at something like a call spread, or I would look at individual names. I was looking at Morgan Stanley earlier today. It's about to break out from the $53 level here. I was paying attention to. You have this massive kind of, I would say, triple top here on Morgan Stanley at 53. And you have this rising support. So I do think that you have the potential of a breakout here. And if you go out to October, you can trade a 52.5, 57.5 puts a call spread for $1.75. That's a little under, you know, 5%. You know, that's how I think I would play a bullish view here on financials, if you will. Dave says he's neutral on Tesla. So Tesla has blown through some. You know, I was convinced that it was going to stop at that 2050 level because, you know, for those of you that happen to catch Carter's play here on Tesla, you know, I thought this was a very clean setup here where you had a $700 run initially, a pullback here, and then another $700 run. It stopped on that, you know, 2050 level on the nose, but is now starting to push higher here. You know, Tesla is really difficult to bet against, but if you're neutral on it, the only strategy that I think makes sense is to sell a call credit spread. Selling a credit spread, in my opinion, is the only way to play a neutral view here on Tesla. So I would go out at least about 50 points wide. So if you go 2250, 2350, and you would want to typically go a few strikes out of the money here because of the fact that Tesla is so strong. As you can see here, this $50 wide credit spread would collect, whoops. Looks like my computer is slowing down here. Maybe Tesla's a very large chain here. So on this $50 wide credit spread, I am collecting $17.50. Those are the types of credit spreads that I think make sense. This is the same type of credit spread that Mike Ho laid out here on Options Action last Friday. So please watch that if you have an interest in this. Kavork is saying he's bullish on GLD. So again, this is gold and silver. I'm not as bullish on because interest rates are rising. But if you are going to play that bullish view, I would go out to October and look at buying a call spread. I would buy the at the money call options, maybe slightly out of the money option to really reduce my risk, and sell the one standard deviation move, or maybe even a little lower like a 92 risking only $300 here on a $181 stock. That is pretty low. That is less than 2% that you're risking here for GLD. So if you want to play precious metals, I do think GLD gives you a little bit more capital efficiency than SLV. SLV, you're risking 5%. Here, I'm risking less than 2%. Very similar play. Obviously, gold not as volatile as silver, but I'm not sure that silver is more than twice as volatile as gold at this point. Brad is bearish on CRM. So, you know, this is one that I'm not, is this right? Is that chart for CRM? CRM made that big move yesterday, right? And you are bearish on CRM. Okay, so you know, here's the thing: is that I think if you're going to be bearish, that's going to be a difficult play. You know, I don't think it's a good idea necessarily to, you know, because the chart here is so incredibly strong. I think you're better off if you're going to be bearish to take a look at selling a call credit spread here. You can go out to October, sell the 280 to 300 maybe, and that'll collect $7.25, which is just a little bit over 1/3 of the width here. And it's about $4 out of the money. So you are getting, in my opinion, some pretty good odds here, about 63% probability of profit. You're risking $12.75 to potentially make $7.25. So better than 1.5 to 1 risk to reward ratio. So I think that if you're playing a bearish view here on CRM, that would be the way that I would do it. Catan is you just said Qualcomm. You didn't say bullish or bearish. I'm guessing you're bullish. So I would look at, I would look at Qualcomm here. You know, I don't have a particularly strong view on Qualcomm. I don't follow this particular stock very much, but I would look at something like a call spread here, risking 482 on a $116 stock. That's about 4% of the stock price. You know, is this going to continue moving higher? Possibly. You know, Qualcomm more in the 5G space, which certainly, you know, I like the fundamentals of, but again, this is not a company that I follow too much. Walmart, you're bullish on it. So, I mean, this was the trade that we made earlier today. We obviously made the trade before the TikTok news came out, and you had to have gotten in at the very early in the morning before, or else you probably would have missed out on this trade. It closed at 136. You know, from my perspective, I think the chances of Walmart acquiring TikTok, I actually think is not that strong. So I'm concerned that you're just going to get a pullback here once that kind of news fades a little. So I'm looking to take profit on our Walmart trade immediately because, again, I didn't expect this news to come out, and the fact that it did come out and move our position, I want to take profits quickly. I think that if you're going to be long, you should wait for a potential pullback. I think that it's difficult to enter this trade on a stock that doesn't move very much, that it's already up 5%. I don't want to chase this. So that's my view here on Walmart. XRT, you're bearish. So, I mean, this is a trade that Carter and Mike had on Options Action a couple of weeks ago. And I agree with the thesis. I just didn't like the timing on it. You know, there's no catalyst, in my opinion, that will drive this market lower here. You know, retail we know is dead. We know retail is not particularly strong. And if you look at the constituents of XRT, I don't particularly like either. But, you know, the markets just keep grinding higher. I just don't see a catalyst to justify buying a put or buying a put spread. You know, I think what's a more reasonable strategy if you really are bearish on XRT is selling a call credit spread, you know, looking at a 53.55, maybe 53.56. You're collecting $1.25 on a $3 wide credit spread. Now, I'm not sure how liquid this is. You're going to have to play around with it. You know, look at how wide these bid-ask spreads are. Now, these are after-hour bid-ask spreads. They might tighten, you know, when the market opens. So I'm not sure that 125 is truly indicative of what you'll get filled at. But chances are you'll get filled a little bit more than 1/3 of the width here, in my opinion. So that's how I would play a bearish view here on XRT. AMD, you're bullish on it. So I tend to agree. AMD, happens to be making the chips for the Xbox and PS5, which are just coming out. And also they make graphics chips for computers. And one of the things that, at least one of the reasons why I was so bullish on Nvidia going into this earnings announcement is because of the fact that you have the new video game consoles coming out, and you have a whole new PC gamers predominantly upgrade their graphics chips around the console releases. So there is potentially some tailwind here for this particular name along with Nvidia. I do think Nvidia by far dominates this space, so I prefer Nvidia over AMD. Nvidia has had a pretty big run here. You have this double top. I would wait for a breakout here. I would wait for a confirmation of a breakout before I would go long. But if you did get that breakout, I think the vertical spread here is the right way to play it. $4.30 on an $83 stock means you're risking 5%. On a fairly volatile name like this, I think 5% is a reasonable amount to risk and play for an upside here for AMD. CX neutral, CX. I don't know anything about CX. Looking at the chart, certainly looks like it's, recently broke out above this resistance level. Looks like it's got some legs here to the upside. It's a $3 stock. I usually don't trade these types of names. So unfortunately, I just don't have a lot to add here because I don't trade these $3 stocks, and you're risking a large amount of the underlying stock to buy a call option. I think you're better off just buying the stock if you're bullish on this. Or rather you're neutral. So I don't think there's really much to play here, in my opinion, on a $3 stock that you're neutral on. ANGI Home Services, I know nothing about the stock also, but it certainly looks like it was a strong stock that is now consolidating. You're bullish on it. So if you're bullish on it, then I would look at, I'm not sure that call spreads here make a lot of sense either. You're paying $1.85 on a $13 stock. That's more than 10%. You're really risking more than 10% of the stock. Those are not the type of trades that I like to play where you're risking more than 10% on the stock and there's no earnings coming up. You don't have a catalyst or a real reason to be, this stock will rise significantly. Nothing in the chart particularly shows that. NBIX, also a stock that I know nothing about. Neurocrine Biosciences. Is this the one that came out yesterday on the warp speed stuff? No, it can't be because the stock hasn't moved. I don't have a whole lot. It's a relatively strong stock from a technical perspective, but the chart looks pretty weak here. You've now fallen below this kind of support level, if you will. Think of this as kind of a bit of a topping formation. And now it's fallen below this level. And now perhaps I think it's going to head lower here. You're bullish on this? So, looking at this, if you're bullish, an October will cost you $7.95 for a call spread. And maybe you do a 115, 130 call spread costs you only $4.95. So this isn't so bad here. You're paying $4.95 for a $114 stock. That means you're risking less than 4% or roughly 4% or so. That's probably not a bad play here if you're bullish, but the chart doesn't look particularly attractive for a long, in my opinion. I think you have a better chance of this moving lower. GLD and Walmart have already gone over that. Amazon, Amazon is pretty much a one-way chart here, and I think it's going to head even higher here. This one is a tough one because you have a $340,000 stock. Trading an option here going out to even October would cost you a very, very pretty penny here. So for those looking to play Amazon on the cheap, the way that I would do it is by buying a call option that's a little bit out of the money and selling one that's not far much higher than that. It's more of a binary play. You don't have a whole lot to risk, but you also don't have a whole lot to potentially gain here. You're risking $3,400 to try to make $4,500. If Amazon is above $3,500, that's another $100 higher. And Amazon moving $100 higher is not a crazy move here for Amazon, but these types of really tight debit spreads is really, in my opinion, one of the few ways to play Amazon. Etsy bullish. Now, Etsy continues its move higher here, and I kind of like the fact that it's consolidated a bit, because if you can see historically on this chart, every time it makes a move, it consolidates, moves higher, consolidates, moves higher, and consolidates. So can it move higher? You know, I don't particularly know a whole lot about the fundamentals of Etsy. I haven't looked at that very closely. I do worry, you know, has revenues actually grown this much since the beginning of the pandemic? You know, when it was trading at $60, has revenues more than doubled since then? I don't think so. That's not the feeling that I've gotten from looking at this. So I do think that from a valuations perspective, this looks pretty stretched. So if you're bullish on Etsy, I strongly advocate that you look at strategies like this, where I'm risking $6 on a $122 stock. That's 5% of the underlying stock price. Etsy, you know, can move quite a bit. So when you're risking 5%, I think that's a reasonable amount to risk on this. But I think this is also the type of stock that if the market shows any bit of weakness, you're going to see a pretty big flush out here on a stock like Etsy. CVX, you are bullish on Chevron. I don't know that there's a lot of people that are bullish in these types of names. You know, with a stock that looks like this, you know, unless you know something that I don't, that's going to give this a catalyst to the upside, my preference would be to sell a put vertical rather than buying a call spread. So something like selling, let's go out to October. We'll sell the 85s, which are the at the monies, and maybe buy back the 80s. So here's a $5 wide credit spread where I'm collecting $2. That's 40% of the width. That is the type of vertical width that you want to try to get, because for the $2 that you're potentially making, you're only risking $3 on the back of that. That risk reward ratio for a credit spread is ideal. That's really usually the best that you get is about a 1.5 to 1 risk reward ratio. So Chevron, interesting play if you're bullish, but my preference would be to sell the put spread rather than buying calls. PayPal, you're bearish on PayPal. I don't know a lot of people that are bearish on PayPal. You know, trading at 204, you certainly have this double top here, which could be concerning for some investors of this double top. If you're bearish, I think the best way to do is play that double top. Use that double top to your advantage. Bet that the stock will stay below that double top. You can use something like a 205. Oh, they don't have a 205 strike. You would have to sell a 210, 220 or 210, 230 strike. You know, that's a $20 wide credit spread here. You're only collecting $5.70. That's not particularly attractive. So the 210, 220s, you're collecting 340, which is 34% of the width. That is actually pretty good, because this is something that's almost $6 out of the money. So you have another $6 to the upside and then another $3.40. So you actually have, you know, a break-even price that's almost $10 higher. So as long as PayPal doesn't rally $10 or more, you can make money on this trade. And you're risking, in this particular case, 2 to 1, which is pretty standard for a credit spread. But you got that $10 buffer, which, you know, if you're bearish on PayPal, you know, that should be a level that you might be comfortable with. CERS, I don't know anything about this stock. You are bearish on it. Put options here are relatively cheap for this stock. That's actually quite volatile. This is $1.30 on a $6 stock. So that's what, 20% of the underlying stock price. But obviously, because the stock can move, 20% may not be a whole lot to pay for that put option. But I think this is pretty speculative in nature. But again, I don't know anything about this stock, so unfortunately, I can't comment. Bank of America, again, I like the financials, and Bank of America would be a pretty pure rates play here, in my opinion. So I like this, and you can pick up and let's say I would go out to October. I would look at the 26.29 call spread here, paying $1 on a $26 stock. That is roughly a little over 3% of the underlying stock price. So a little over 3%, I think, is a pretty reasonable bet, because in the Morgan Stanley trade that I was looking at before, I was risking almost 4.5%. Here I'm risking 3%, a little over 3%. So I actually quite like this Bank of America play that we just found here together. This was one that I had not thought about from a banking perspective, but I do think if you're bullish on financials, Bank of America might be a very interesting play to make. Square. Square, same thing with PayPal. You know, not a lot of people that are bearish on this because, again, online e-commerce spending. So when we think about consumer spending, right, it still remains fairly strong. If we look at consumer card spend, look at debit card and credit card spend, it is at the same level as it was same time last year. I know that sounds crazy, but that is the case. So when you look at, you know, credit card processors like Square, you know, there's been a significant shift into e-commerce and all the spending that has been taken out of travel. You know, think about all the places that we're not spending: travel, entertainment, restaurants, movie theaters. When we're not spending those money and we're clearly spending it somewhere. Online e-commerce, home improvement, and online electronics. Those are the three places that we are spending as consumers. So Square clearly in you know, a beneficiary of this, and we have no sign, we do have no signal that this has slowed down or stopped. So I do think Square bullish here makes some sense. I would potentially play for a breakout here because you have this pause here and you might get a breakout. Square is an expensive play here. On a $155 stock, what does concern me here is that you're paying $910. $910 on a $155 stock is 6%. And, you know, Square doesn't have earnings coming up. So I think 6% is on the higher end that I would want to risk here on Square. And I also don't think selling a put spread makes a lot of sense here because you're at a double top. You know, this is, you know, from a risk to reward ratio here, you don't want to take on more risk, you know, to do so. So I don't love selling a put spread here either. And you're only collecting $6.50 for a $15 wide credit spread. It's not bad. But, you know, that's not the type of risk to reward ratio that I would love. I wouldn't want to risk 850 to just make 650 when it's at a double top, unless it's broken out above that double top, which it has not done just yet. So I'd be a little cautious on this just at the moment. John Deere has taken off, and industrials, you know, industrials certainly has seen some strength, but that strength has not lasted. So I'm not 100% sure that John Deere's strength is going to continue here. But I think the only way to play this, if you're going to do it, is using a call spread like this. I would even go the first strike out of the money here. I wouldn't buy the 200s. I'd buy the 210s. Really reduce your risk here. 720 on a $209 stock means you're risking 3%. No. I'm drawing a blank. 720 divided by 209.83 is... yeah, 3.4%. So I'm risking 3.4%. That's a small amount of risk on a stock like John Deere. You know, John Deere actually has a slightly higher beta than I was expecting, 1.17. So perhaps risking 3.4% on a flyer here for John Deere is not too crazy. Dan wants to look at Disney, and he thinks that Disney is overbought. So, you know, my view on Disney here has shifted a little here. This is one of the stocks that, you know, I think that, you know, with COVID-19 cases now declining, you know, both if you look at cases, you look at positive case ratio, if you look at hospitalizations, you look at deaths, they've all been trending steadily down here for the last 2 to 3 weeks now. And, you know, Disney is really the type of stock that is would be fairly beneficial for COVID-19 cases to come down, reopening, and potentially the vaccine. So you really have three of these, I would say, confluences that could potentially have Disney go significantly higher here. So from my perspective, I think that if you're going to take a bearish view here on Disney, you got to do it with limited risk. You know, the fact that it's at a double top does mean that buying a put spread from a risk to reward ratio here makes a lot of sense. Buying a put spread here costs $409 on a $133 stock. That means you're risking 3%. That is the only way, in my opinion, to take a bearish view here on Disney. But I wouldn't be surprised if I saw Disney pop higher here. You know, again, even though I had a bearish view going into Disney earnings here, that was my bearish trade here on Disney. I do think my views here have changed a little as COVID-19 cases have declined. We have more and more vaccine, you know, what looks like good news coming out of the vaccine front. You know, that has impacts on sports, that has impacts on the on the, which Disney owns ESPN of. This has impacts on the theme parks. So that is the kind of, I would say, black swan here for Disney. And I think that the risks are actually skewed to the upside rather to the downside here for Disney. TTD, Trade Desk. We've been looking at this for a while, but Trade Desk just doesn't move, but it has continued to make higher lows. So it could potentially move higher here. I just, I know the business, but I don't really understand why this business is really, why the stock has taken off so much here. There are, in the algorithmic trading space, electronics trading space, volumes are okay. Volumes haven't taken off the way that the stock has taken off. So I'm a little weary about this move here, in my opinion, on Trade Desk. And when it trades at such a crazy multiple, I'm always a little weary. You're bullish on Trade Desk, and I'm not really sure why a lot of traders like this, because it's not a very liquid stock. You are risking quite a whole lot here to place this bullish bet. $2,700 on a $472 stock. Well, I guess that's not a whole lot. I guess that's a little over 5%. I'll be honest, it's just not something that I have a strong opinion on. So my preference would be to reduce risk as much as possible on a flyer like this, but that's a flyer for me because I don't know the stock very well. So I would choose to use something like this, but $2,700 is not a cheap trade to make. Dollar General, this is one that has, it's been a really boring stock. I like the stock, I really do. It's one of the few stocks, Tractor Supply and Dollar General, I really like the stock, but it's just really boring. So I think that the only way to make any money on this bullish view is to sell a put vertical, similar to the Walmart play. Basically look for it to grind higher. Here, $5 wide credit spread, $10 wide credit spread collects you $3.80. That's 38% of a $10 width. That is the type of trade that I would find attractive on a stock like Dollar General. Lam Research, this is one that I was looking at. I'm actually quite bearish on it because Lam Research recently just broke below this major support level here. So it's down at 341. I think that this could potentially lead to some acceleration here to the downside. Pradeep, you didn't mention if you're bullish or bearish, but this is one that I think that recently declined below some support levels, could see some acceleration to the downside. I actually have a position here in Lam Research. I have a short position. I don't know how long I'm going to hold on to it, but it is one that I have. It's an expensive stock, so you are risking a substantial amount here to place this trade. So be careful on this. I did enter this trade here a little earlier than this, but we've seen this acceleration to the downside, and I think this could continue. SRNE. I don't know the stock, Sorrento Therapeutics, very well either. This is obviously one of the COVID stocks, and you're bullish on it. So the stock has had a pretty significant decline here. The only way I would be interested in playing this is using a call spread. Now, I do think that these bid-ask spreads perhaps are a little distorted for after hours. But paying $1.10 for an $8 stock, you're still risking just about 8% of the underlying stock price, a little more than that. So be careful when you're risking 8% of a stock. Okay, so I have so many more. I'm really trying to get through as many as possible. I don't think I'm going to be able to, but I really hope that I was able to get through quite a few of them. Let me see. Let's see, Microsoft recently breaking out to new all-time highs. This is one that I do like. Between Xbox coming out and just the general cloud computing domination that they have had, I like this. My preference would actually be to buy that call spread. I'm looking for that acceleration here to the upside. I think you could get another push here to the upside. Risking $1,000 on a $226 stock means you're risking about 3%. Those are the types of, a little under 3%. Those are the types of plays that I look for on a stock like, especially in a technology space like Microsoft. I'm guessing it's CrowdStrike that you're looking at. CrowdStrike, you know, you've had this triple top here. I do like cybersecurity. There's no doubt about the fact that cybersecurity is going to be a key player here or a key differentiator here post COVID-19, but you have this triple top. So the only way that I think makes sense to play this is using a call spread. You want to limit your risk. I would even use something like a 120, 140 call spread, risking just $5.90. That's about 5% of the underlying stock price on a pretty, you know, I would say significant potential mover here. Risking 5%, I think, is potentially interesting. Workday, is it okay to sell an iron condor? So, you know, after a big move, selling an iron condor is actually one of the few times that I think could make some sense. You know, a lot of times people want to sell iron condors when they've seen the stock move sideways for a long time. In my opinion, that's the worst time to sell an iron condor, because after the stock is traded sideways for a while, that's when you have the largest opportunity for a big move. It's actually after a big move that when you want to actually consider selling an iron condor and basically be short volatility. But generally speaking, you want to wait for a move to the downside to short iron condors, because when you get a move to the upside, volatility is actually lowest. So it's not the best scenario to sell. So you can sell an iron condor, but I do think that, you know, you got to be careful in terms of your strike selection. You know, I'm not a big fan of selling iron condors. I think I would be better off, you know, in my opinion, what I would do is, if you want to sell an iron condor, is I would sell a call credit spread first. I would look at selling a call credit spread, like maybe a 220 to 30 call spread here, collecting $3.80. If you do get a move to the downside, then start selling the put side on the downside. I never like to sell the call and the put spread at the same time, because I'm never in a scenario where I'm bullish and bearish at the same time. And I certainly don't have any indicators that tell me Workday is just going to go sideways. There's no technical indicator that I'm familiar with that's going to tell me, well, Workday is just going to stay in this 260 range and it's not going to move. That's why I'm not a big fan of selling iron condors. You know, iron condors at the end of the day is a short volatility play. It's not really a directional play. A lot of people think of them as a directional play, but it's much more of a short volatility play. And, you know, Workday has popped, volatility is at its lowest. So this is not, in my opinion, the best time to sell an iron condor. Talked about Nike, Walmart. Let's look at Nike here. Nike has had a pretty significant run. Hasn't caught up to, you know, Lululemon stratosphere moves here, but Nike, as you know, I was long Nike. I actually recently just got out of this, but it looks like it's got some legs to continue here to the upside. This is one that I initially rolled the position up, and then because it kind of went sideways, I thought it lost momentum, but it actually had a little bit more momentum. I could have held on to that trade, but I didn't. So I'm not 100% sure how much higher Nike can go, because if you look at clothing spend, it's not particularly strong. It's one of the categories that is on the, you know, has not been particularly strong. You know, online electronics, online e-commerce, far stronger than clothing spend, partially because, you know, we don't really have a lot of places to go. Yeah, I mean, Nike certainly is, you know, more than just sneakers and clothing, but it's a whole brand around it. But without sports, without you know, people going out or going back to school, this is, generally speaking, in my opinion, not the best environment for a name like Nike. So I do think that if you're bullish, I prefer to be selling put spreads here, you know, because I don't think that you're going to get as much of an acceleration here to the upside. I think more of a neutral view makes sense. And it's not particularly attractive. $332 for $668 worth of risk. Not that great. So not my favorite play. PANW, is that Palo Alto Networks? So I don't know a whole lot about this stock, but, you know, technically looks fairly strong. You've got this pullback here, and I think that that is an opportunity for a long position here. It generated a buy signal here today. If I were you, I would be looking at something like a 255, 280 call spread. $1,000 on a $255 stock, so you're risking about 3.5%. You know, at 3.5% on a stock, not a bad play here, in my opinion. You're actually pulled back a little further, right to that support level. So, you know, here's an example of a trade that you can when we say we're risking $1,000, you're actually, in my opinion, risking substantially less, because if the stock goes below that 255, I would cut this trade immediately. Maybe you risk $250, $300 on this particular trade if the stock declines immediately below that 255. If you do get a move to the upside here, you're looking at potentially $1,900 worth of potential reward. You know, when in reality, I think you're only risking closer to $300 to $400 rather than $1,000. This is the type of play that I do like, because now you're risking only 1% to 2% of the underlying stock price because of the levels that you're getting into. And this is really where technical analysis, you know, really shines, because you can get really fine-tuned in terms of your entries and have a really sharp risk to reward ratio on your trades. So while I don't know a whole lot about the stock, but the technical setup I quite like. We went over Tesla, Intel, you know, ever since we've hit that $48 level, I've been saying that I think it's worth selling some selling puts. So this is actually what I've been doing in my own portfolio, is selling some put options here on Intel, because I do tend to agree that long term, you know, Intel got knocked down from their 7 nanometer chips, but I do think long term this will likely recover. So my preference here is to sell put spreads. I'm sorry, selling puts. You're collecting a fair amount of the premium, not as high as it was a few weeks ago, but you're still collecting 21% yield, and you could potentially own the stock at $46.87. You know, I'd be comfortable owning the stock at $46.87. Those are the types of returns that you would want to seek in a short put like this. Okay, so I know that there were more symbols, but I really tried to go through as many as I possibly can. I really hope that you guys find this useful in helping you better understand, number one, how I view the markets, but way more importantly, how I'm looking at using options to limit my risk. This type of market environment that we're in, it is so important that you have a laser focus on managing your risk. And most of the trades that I showed you, we were risking 3, 4, 5% of the underlying stock price. If you do get a market correction of 10%, you want to make sure that you don't lose 10% of your portfolio as a result of that. You want to make sure that you're trying to risk 3, 4, 5% of the stock's value when that does happen. So with that, that covers what I wanted to show you here today. I hope that you guys find this useful, and we will send out the recording to everyone. Before you go, I want to share with everyone the YouTube channel so that you can sign up for the replays. So a lot of people ask, you know, how do I get access to the replays? Those are all available to you on our YouTube channel. So I'm posting a link here into the chat window. You can sign up for that. And this allows you to utilize the platform and understand how to utilize this platform. So thank you so much. And a big thank you to all of our members for supporting us and allowing us to continue doing this. You know, I love doing this in terms of helping you guys learn and teaching you what I basically do for a living. And it really allows me to continue doing this. So please consider supporting us if you are not currently a member. If you are a member, you're going to get a lot of benefits, such as the daily trading plays, the market outlook session recordings, the Tom Sosnoff recordings. All of this is available to you as a member. And if you don't have an account, you can sign up for a free trial for 30 days at OptionsPlay.com. So you can sign up for a full 30-day trial, test things out before you decide whether or not a membership is suitable for you. So thank you so much. Have a great evening, and I'll see you guys here tomorrow morning at 9 a.m. And where we will go over a far more in-depth view on the current markets. I think I'm going to do a sector review tomorrow morning of all the sectors where we currently sit, and give you some, again, some of the more detailed views of the warning signals that the markets are currently flashing. So have a great evening. I'll see you in the morning.